Do you want to get rich quick, buy a house with cash, and drive around in your new Ferrari? If so, this is not the video for you. Gotcha. Now, we all hope these get rich quick schemes really worked, and if they did, we'd be rich by now. There are no secret formulas, and you can't get rich in a matter of weeks or months without huge risks. And even the biggest entrepreneurs had to work 18, 20 hours a day for years to create their vast wealth. Even if you did the lottery and won, you wouldn't even know what to do with the money. And as with most lottery winners, you'd be flat broke in just a few years. Building and maintaining wealth takes time and effort. So today, I'm going to go through the basics of how you can grow and maintain your wealth using the stock market. For me, wealth is about securing my future and aiming towards financial independence. I want to have the freedom to do whatever business I want to do, give my kids a good upbringing, and spend more time doing what I want to do. Everyone will have their own goals. You may want to save up for your kids' college fund, be able to travel the world, or have something to pass on to your grandkids. Maybe you have a side hustle or two, or you have extra money left over from your paycheck and you don't know what to do with it. Have you thought about investing in the stock market? Now, investing is something you want to do for your future. Buying and holding ETFs or index funds for the medium to long term and cash out in the future when the money has accumulated and compounded. So for simplicity, here's a short scenario. I have $1,000 sitting in my savings account for 5 years. I may gain interest on those savings, but it's generally not enough to cover the rise in inflation, and I'll end up with near enough the same money I started with. Whereas if I invest in the stock market for an ETF that tracked the stock market, and using the statistic for the past 5 years up to June 2019, the Australian stock market returned an average of 9%, and you'll be looking at a figure of around $1,566. That's $566 compound interest over 5 years. And if you look at the doubling effect of compound interest, with a return of 9%, your money will double every 8 years. Now, if you're still unsure about long-term investing, this graph will show you returns over the past 30 years, where the Australian market has returned an average 10%, and the US market has returned an average 11.8%. That definitely beats any savings rate you'll get with your bank. So now if we're looking at an example of 30 years long-term investing, so say you put away $500 a month for 30 years, you'll end up with a portfolio looking something like this. Now that's a good investment right there. Almost $1 million, and 80% of that comes from the compounding effect of the stock market. Now, you may be skeptical about putting your money into the stock market for the risk of losing it. But in reality, if you invest it over the long term, there's near enough zero chance you'll end up with less than what you started with. Also, just a quick tip I'd like to add, before you jump in and put all your money into the stock market, make sure you have some money as a backup and as an emergency savings account. This will really help you when times are hard, so you don't have to draw anything from your investments. So now we're going to go through a few basic things about investing. There are two main types of investing, active and passive. An active investor is generally someone who tried to beat the market, buying individual stocks, waiting for the price to rise and then selling them for a short-term gain. Whereas a passive investor aims to track the market, buys ETFs and holds on for the long term. Shares are sometimes known as equities, securities or stocks. When investors buy shares, they effectively get a stake in the business and a chance to earn a profit if the company performs well. Shares are considered the most risky of all the asset classes. The price of shares can fall as well as rise. That means you could lose money. And in a worst case scenario, you could lose all of your money if that company goes bust. ETF stands for Exchange Traded Fund. and they replicate indexes such as the ASX 200 or the S&P 500 or other groups of underlying assets. So you can buy the whole market in a single purchase at a relatively low cost. ETFs are listed on the stock market and are bought and sold just like shares. When you invest in an ETF, you buy units in the fund, which are listed on the stock market and will rise and fall on a daily basis, usually in line with the assets in the fund. So the four main benefits of ETF investing. Number one, diversification. They provide exposure to lots of different assets through just one trade. Number two, accessibility. You get access to asset classes which is generally difficult to reach. Number three, low cost. ETFs generally have a lower fee when compared to other managed funds. And number four, transparency. So as I said before, ETFs are listed on the stock market so you can monitor their value and holdings daily. There are risks with ETFs as they can fall in value and you can lose money. Some ETFs are more risky than others, so it's important to understand what you're buying. So I've only had experience using one platform and one sub-platform buying my ETFs and stocks. I'd like to share them with you now. The main one I use is ComSec, which is through Combank. They have a minimum $500 investment amount for around about a $10 fee. And then they have a sub-broker, I guess, which is called ComSec Pocket. They have a minimum investment of around $50 and only a $2 fee, or a 0.2% fee of any investment over $1,000. So if you want to get started in buying ETFs in Australia, ComSec Pocket is the app I would choose to use, mainly for the low fees, and they have a decent selection of ETFs you can choose from. So we go through that list of ETFs now. I'll put it up on the screen for you. They have the Australia Top 200, which is IOZ. They have the Aussie Dividends, which is SYI. They have the Global 100, which is IOO. They have the Emerging Markets, which is IEM. They have Healthwise, which is IXJ. They have Sustainability Leaders, which is ETHI. And then the final one, Tech Savvy, which is NDQ. So have a look at the app and check them out and see which one is best suited for you. With the ComSec Pocket app, you can invest at any time, and you can also set up an auto buy so you don't end up spending your money elsewhere. It's a good way to start planning for your financial future. The worst place to be in investing is not be investing at all. Then you've got no future gains and your money just sits in your savings account, stagnating and losing value due to inflation. And the little bonus tip right here, if you do the lottery and you end up winning $100 million, I know it's probably unlikely, but if you do, I'd say chuck most of it into a high yield dividend paying ETF, and you can spend your life earning around $5 million per year in dividends alone. So I'd like to say thanks for you guys for watching and staying to the end. I hope you've all enjoyed this video. Please subscribe if you'd like to stay up to date with these videos, and also leave a like and a comment just below. I'll leave links to the references I've quoted below in the description if you'd like to check them out for yourself. I've also got a few Amazon affiliate links in my description below. These books I've read myself and I find very helpful, and hopefully that you can find them helpful too. And if you click through the link, it won't cost you any more money, but it just throws a few % of the profits my way to help me fund this channel. Anyway, thanks one more time guys, and I'll see you on the next one. Peace.